Stop what you are doing right now, because if your CPP deposit on March 27th looked different than you expected, you are not alone, and there is a very specific reason this is happening that most people never get explained to them properly. Thousands of Canadian seniors checked their bank accounts on March 27th and had one of two reactions. Either they said, "Wait, this is more than last month, what happened?" Or they said, "Hold on, this is less than I thought it would be. Did the government make a mistake?" And here is the thing, both of those reactions are completely understandable. But in almost every single case, there was no mistake. What happened on March 27th is actually the result of a system that has been working exactly as it was designed. And today I am going to walk you through every single reason why your CPP may have looked different, so that by the end of this video, you will know exactly what your payment should be, why it is what it is, and what steps you can take if something genuinely needs to be fixed. My name is Tyler. Welcome back to CPP Experts, and let us get into it. Let us start with the most important foundational fact that you need to understand before anything else makes sense. Your CPP, the Canada Pension Plan, is not a fixed number that stays the same forever. It is indexed. That means the government adjusts it every single year to keep pace with the cost of living. This adjustment is called the COLA, the Cost of Living Adjustment, and it is tied to the Consumer Price Index, which is the official measure of inflation in Canada. For the year 2026, the government confirmed a COLA increase of exactly 2%. That means every single person receiving CPP in Canada got a 2% increase applied to their payment starting January 1st, 2026. Not March, not February, January. Now here is where the confusion begins for a lot of people. Some seniors are watching their bank statement and comparing their March 27th deposit to what they were receiving in late 2025, and they are surprised by the difference. That difference is the 2% COLA that kicked in on January 28th, the very first payment of 2026. By the time March 27th arrived, that increase had already been in your payment for 3 months. So if your March payment looks higher than your October or November payment from last year, that is why. The COLA did that. Now let us talk real numbers, because that is what actually helps people. The maximum CPP retirement pension at age 65 for 2026 is $1,507.65 per month. That is the absolute ceiling, the most anyone can receive. In 2025, that maximum was approximately $1,433 per month. So at the top end, the 2% increase added about $74.65 per month to the maximum payment. But here is the critical reality that you must understand. The vast majority of Canadians are not receiving the maximum. The average CPP retirement pension for new beneficiaries at age 65 is actually around $803.76 per month. So on an average payment, a 2% increase is adding roughly $16 per month, not $74, $16. And this is exactly why so many people feel confused or even disappointed when they check their deposit. They have been hearing about this increase. They expected something significant, and then they see an extra $14 or $16 or $18 in their account, and they think, that cannot be right. But it is right, because your 2% is calculated on your personal CPP amount, not on the maximum. Your increase is 2% of what you actually receive. Now I want to go deeper, because the question, why is my CPP different than expected, has more than one answer. Let me walk you through every possible reason, one by one, so you can identify exactly which situation applies to you. The first and most common reason is what I just explained, the COLA increase that came in January. Your March payment should be identical to your February payment, and both should be identical to your January payment. All 3 2026 payments should carry the same 2% increase applied to your 2025 base amount. If January, February, and March are all the same, and they are all higher than your December 2025 payment, that is completely normal. That is the system working correctly. The second reason your payment might look different is something that not many people talk about openly, and it has to do with the timing of how Service Canada processes individual files. In some cases, and this happens to a smaller number of recipients, the January payment was processed before the individual's file had been fully updated with the new 2026 rate. When that happens, Service Canada will include a small retroactive adjustment in a later payment to make up the difference. So if your February or March payment was slightly higher than your January, and you cannot figure out why, there is a good chance you received a small catch-up amount. This is not a gift. It is your money that was owed to you from January, paid slightly late. The third reason, and this one is extremely important for a specific group of seniors, is something called the post-retirement benefit, or the PRB. If you are someone who continued working and making CPP contributions even after you started collecting your CPP retirement pension, then you are entitled to something called the post-retirement benefit. This is an additional monthly payment on top of your regular CPP, and it is based on the contributions you made while you were working and also receiving your pension at the same time. Now here is where it gets interesting and where a lot of confusion happens. The PRB becomes effective on January 1st of the year after you made those contributions. But Service Canada cannot actually calculate and issue your PRB until they receive the contribution information from the CRA, the Canada Revenue Agency. And because of how tax filing and employer reporting timelines work, Service Canada typically does not have all that information until early spring. So what happens in practice is this. Your first PRB payment usually arrives in April, and it includes a lump sum that covers January, February, and March all at once. For some people, that April deposit will suddenly be $150 or $200 or even $300 higher than their March deposit, and they panic. They think something wrong happened or that they were overpaid, and they call Service Canada in a panic. Do not panic. If you worked in 2025 while collecting CPP, that larger April payment is almost certainly your PRB lump sum finally arriving. After that, the PRB amount gets folded into your regular monthly payment going forward. The fourth reason your CPP might be different than you expected comes down to the age at which you started collecting. This is a very common source of confusion, especially when seniors compare their payments to friends or family members. The CPP pension is not one size fits all. The government designed it with a flexible start date system. If you started collecting at age 60, which is the earliest possible age, your payment is permanently reduced by 7.2% for every year before age 65 that you started early. That is a total reduction of 36% if you started at age 60. On the other hand, if you delayed starting CPP beyond age 65, your payment increases by 8.4% for every year you waited, up to a maximum increase of 42% if you waited all the way to age 70. And here is why this matters for the COLA confusion. When the 2% indexation is applied, it is applied to whatever your personal base amount is. If your base is permanently lower because you started early, your dollar increase will be smaller. If your base is higher because you delayed, your dollar increase will be larger. Two people who worked identical careers and contributed identical amounts can have completely different monthly payments based purely on when they chose to start. The fifth reason, and this one surprises a lot of people, is tax withholding. Your CPP payment has a gross amount and a net amount. The gross is what the government sends. The net is what lands in your bank account after income tax is deducted. Now, CPP is taxable income. Every year, Service Canada withholds income tax from your CPP based on the tax rates that apply to your total income situation. If your total income changed, maybe you started receiving OAS, or you have rental income, or you sold property, Service Canada may have adjusted the tax withholding on your CPP to better reflect what you will owe at tax time. So if your gross CPP is actually the same, but your net deposit looks smaller, the first thing to check is whether your withholding rate changed. You can request a specific withholding amount using the Form ISP 3520 CPP, and you can always call Service Canada at 1-800-277-9914 to ask them to clarify the gross versus net breakdown of your payment. There is also a sixth reason that is becoming more relevant every year, and it has to do with the CPP enhancement. Starting in 2019, the government began a multi-year enhancement to the CPP. Every year since 2019, the formula for how much new CPP recipients receive has been improved. This enhancement is fully phased in now, but here is the consequence. Someone who began collecting CPP in 2020 or 2022 or 2024 has a different formula applied to their benefit calculation compared to someone who started collecting in 2010 or 2015. The newer recipients benefit from the enhancement in their base calculation. This means that if you are comparing your CPP payment to what your neighbor or sibling or friend receives, and you are not accounting for when each of you started collecting, you are comparing apples to oranges. The CPP enhancement does not retroactively help people who were already collecting before 2019. It only benefits those whose contribution years and benefit start date fall within the enhancement period. Now I want to shift gears and talk about some of the mistakes that I see seniors make repeatedly when it comes to their CPP, because understanding these can save you a lot of stress and potentially a lot of money. The biggest mistake is assuming that because a friend or family member receives a certain amount, you should receive the same. CPP is one of the most personalized benefits in the entire Canadian system. It is calculated based on how much you earned throughout your working life, how long you contributed, what years you contributed, and when you chose to start receiving it. No two people will have the exact same CPP unless they had literally identical working histories and identical start ages. When someone says to you, "I get $1,100 a month," why do you only get $780? The answer is that your working histories were different. There is nothing wrong with your payment. The second mistake is not checking your My Service Canada account regularly. This is a free online portal where you can see exactly how your CPP is calculated, what contributions you made in each year of your working life, and what your estimated payment would be at different start ages. If you have not set this up yet, I strongly encourage you to do so. Go to canada.ca and search for My Service Canada account. Having access to this information gives you the power to verify that your payment is correct and to flag any errors in your contribution history before they affect your benefit. The third mistake, and this is specifically about GIS recipients, is not understanding how the income thresholds work when you have employment income. GIS, the Guaranteed Income Supplement, is a needs-based benefit on top of OAS. In 2026, a single senior on OAS can receive up to $1,108.74 per month in GIS if their income is below $22,488 per year. But here is the thing that many working seniors do not realize. The first $5,000 of employment or self-employment income is completely excluded when calculating your GIS eligibility. And then 50% of employment income between $5,000 and $15,000 is also excluded. That means a senior who earns $15,000 from part-time work is only being counted as having $5,000 of employment income for GIS purposes. This is an intentional government policy to encourage seniors to keep working without losing their GIS. But if you do not know this rule, you might assume you are ineligible for GIS when you are actually not. The fourth mistake is not knowing about the OAS recovery tax, also known as the clawback. If your net world income in 2025 exceeds $95,323, the government will start reducing your 2026 OAS payments. For every dollar of income above that threshold, you lose 15 cents of OAS. This recovery tax is calculated based on your previous year's income tax return, which is why it often catches people off guard. The reduction shows up in your current year payments based on what you earned in a prior year. If you had a one-time income event in 2025, a home sale, an RRSP withdrawal, a large inheritance, it may have pushed your 2025 income above $95,323, and you may now be seeing a reduced OAS payment in 2026 as a result. The clawback is temporary in that case. Once your income returns to normal, your OAS returns to its full amount the following year. Now let me give you some expert-level insight that most mainstream resources do not cover clearly enough. One of the most underused strategies for protecting GIS and managing the OAS clawback is the tax-free savings account, the TFSA. Any income you withdraw from a TFSA is completely tax-free and does not count as income for GIS or OAS clawback purposes. If you have savings or investments outside your TFSA, transferring them inside the TFSA within your available contribution room means that future withdrawals from those savings will be invisible to the income calculations that affect your GIS and OAS. This is not a loophole. This is exactly what the TFSA was designed for. And for low to moderate income seniors, the difference between having investments inside versus outside a TFSA can literally be the difference between receiving full GIS or receiving nothing. Another insider tip: if you are approaching age 65 and you do not need your CPP right away, deferring it by even 1 or 2 years can have a dramatic long-term impact. Every month you delay past age 65 increases your CPP by 0.7%. That is 8.4% per year. If you wait until age 70, your CPP is 42% higher than it would have been at 65, permanently. And that higher base is what gets indexed by COLA every year, over a 20 or 25-year retirement. Deferring CPP is often one of the most financially powerful decisions a senior can make. And finally, your OAS. Remember that OAS can also be deferred past age 65 by up to 5 years. Each month you delay OAS after 65 increases it by 0.6%, up to a maximum of 36% at age 70. For those who are still working at 65 and have income above the OAS clawback threshold, deferring OAS eliminates the risk of having to repay it during your high-income years. Let me leave you with the key takeaways from today. Your March 27th CPP payment reflects the 2% COLA increase that has been in place since January 28th. The maximum CPP is $1,507.65, but the average is around $803, and your increase is 2% of your personal amount. If your March payment is identical to January and February, everything is working correctly. If it is slightly different, check for retroactive adjustments, PRB lump sums, or tax withholding changes. Your CPP is personalized. Never compare it directly to someone else's. And if you are unsure about any of this, log into your My Service Canada account at canada.ca or call 1-800-277-9914. Thank you for watching Canada Pension Insights. If this video helped you understand your March 27th payment, please give it a thumbs up. It helps other Canadian seniors find this information when they need it. And if you have a question I did not answer today, drop it in the comments below. I read every single one, and your question might become the next video. Take care, stay informed, and I will see you in the next one.